Nathan. And before we get started on where we're going in this cattle cycle, I want to quickly recap where we've been in the last 2 years. So in 2014, we had that tremendous increase in prices, and it was due to a perfect storm of events that came from PEDV reducing pork supplies in North America, combined with poultry producers who were unable to increase their production due to extenuating circumstances and trade barriers. But at the same time, we had China, who had really come into the global market to import beef for the first time mid-2013. And in 2014, this really hit the market in terms of new international demand at a time when beef production wasn't increasing globally. And so we had that huge rise in prices, unprecedented. And then in 2015, the shine kind of came off. And it was almost like a complete reversal of events as pork producers were expanding their sow herds and PEDV was mostly dealt with. We saw pork production increase 7% in the US. We also saw poultry production had been able to increase, but also highly pathogenic avian influenza resulted in trade barriers that resulted in more poultry in the North American market. At the same time, there were issues with West Coast ports, and therefore beef exports were down to a number of countries in the first half of the year, all of this resulting in an additional 9.5 pounds per person of protein in the US market. Well, the only way to deal with that kind of an increase in supply is to reduce prices, and that's exactly what happened. So US fed prices peaked actually in the fourth quarter of 2014 and have since declined. We've actually seen the entire 2014 price increase come off of the market in 2015. With the exchange rate dropping over the last year, Alberta fed cattle prices actually peaked in May at $200 per hundredweight, and they've dropped 21%, and we're now at around $180. And so the question is, where to from here? So we've had this big increase, and the main thing, though, as a major exporting country, is what's happening internationally and globally that's going to be driving where we go from here. And that's where I'm going to start before we look at the Canadian context specifically. So from 2007 to 2015, global beef prices doubled. But over that time, global beef production was steady, basically, as you can see in the chart. And this is because a number of countries were unable to respond with increased production due to dry conditions, drought in the southern US, as well as in Australia. So we really weren't able to respond to that price signal that the world market wants more beef. And what happened in order to keep that production steady was while grain-fed production in North America was actually declining in both Canada and the US, global production was being supported by increased production in Brazil and India. Now, Brazil produces grass-fed beef, whereas India produces buffalo beef from their dairy herd. These are very different products. They do not fill the hole and the demand for high-quality grain-fed beef in the global market. And so we've got really strong and tight supplies globally for beef as we're moving forward. And we've seen the US already start expanding, and they actually started expanding back in the fourth quarter of 2013 when they started getting rain and they had increased feed supplies. So they've been expanding for 2 years, and 2016 they're looking at beef production to be up 4.5%. And they're on track to increase their inventories back to 2009 levels by 2018. Now, we're calling it expansion, but it's not really expansion. In many cases, these are producers that were forced to liquidate during the drought years from 2008 to 2013, and they're simply restocking back to the inventories that their operations should be at. It's not additional numbers in terms of expansion. To do that, we'd have to get beyond 2018. And so we're definitely looking at more production in 2016 from the US, and how much that's going to push prices down is a question of how much is going to actually be taken up in terms of international demand and exports from countries that are looking for that product. Now, another factor globally is Australia. Australia had been able to expand, and they actually had the largest inventory since the 1970s in 2013. And then they had drought, severe drought in 2014 and 2015. And during that period, they were basically massively liquidating their herds, eliminating all of the growth that they had been able to achieve. And doing that had record large production and record large exports. Now, drought is forecast to continue in Australia throughout 2016 over the next 10 months, with rains coming in the fourth quarter. But regardless of what happens in terms of rains in Australia, they've simply run out of cattle. Slaughter was down in the fourth quarter of 2015 and is going to be down throughout 2016. Analysts in the US and Australia are projecting exports into the global market, because Australia had been a major factor in terms of providing that increased demand out there. They're looking at export volumes being down anywhere between 10 and 15% in 2016. And this provides a great opportunity for North American producers to step in and provide that product. So international demand is really strong right now. In 2015, it surpassed the previous peak in 2001, and this is really being driven by larger demographic factors of larger populations and larger incomes. And so we've got growing middle class. We also have a growing urban population globally that's all driving this demand and interest in animal protein. Now, sometimes demand is a hard concept to wrap your head around. So when you think of 2014 and those record high prices, you can think of cattle around a water trough on a hot summer day, and your pump just can't keep up. Now, some of those cows aren't going to stick around. They're going to go and they're going to go graze. It's not that they're not thirsty. They're going to come back. They're just going to come back when the line is shorter and the trough is full. The international consumer found a price in 2015 that they weren't willing to pay. And they are going to come back as the prices come down, and they find where in that market are they willing to pay the price for that type of product, whether it's grass-fed or grain-fed. And the major consumer internationally that we have a question about is China. So China has seen increased consumption for a number of years as they've been growing their economy. But in 2013, as consumption continued to grow, production plateaued. And this is where they really entered into the international market and increased imports. And as you can see on the chart, their production isn't changing as their government really focuses in on pork and poultry and other things that they really want to be self-sufficient in. So as their consumption and demand for beef continues to grow, their only source for that product is the international market, and who's going to supply it? Now, that Chinese consumer has a number of questions going on right now, and one of them is their government's 5-year plan, which has a number of structural changes that are going to occur in the market that's going to slow down growth, probably slow down domestic disposable incomes, which means they may not be growing beef consumption as fast as they have previously, but they are still growing that consumption and are going to continue to need imports. So China's a little bit of a black hole in terms of data and statistics. So official numbers are only a fraction of what total imports are into the country. And you can see them on the orange bar there. But gray channels into China represent the bulk of product flowing there. And they represent about 1.4 million tons of beef imported into the country. That's equivalent to what the US imports annually and makes them the first or second largest beef importer in the world. And so what happens here has a major impact on global markets. And you can see that imports were actually down in 2015. And the reason was because the Chinese government put on an anti-smuggling campaign because they didn't want gray channel imports anymore. They wanted the revenues from the tariffs coming in through official channels. And so official imports increased 44%, but the declines in gray channels were greater. And so overall imports were down. This is expected to rebound in 2016, increasing volumes, including official imports. And so the countries that are benefiting right now from China are those like Canada who have market access into this country. So we not only have strong domestic demand really driving the market here, we also have strong, not only strong international demand, but strong domestic demand. We actually have the strongest domestic demand for beef since 1989. And that means that it's not only been tight supplies that have supported higher cattle prices in the last 4 years, but it's also been stronger demand. If demand had been at 2012 levels last year, beef prices would have been 19% lower. So having beef demand sustained both domestically and internationally is really important in terms of answering the question of where are our prices going to be going over the next 5 years. If we can sustain that demand, the prices are not going to see as large of a drop due to increased supplies as they would otherwise. And something that I can't stress enough is the importance of consumer health perceptions around red meat and the impact it has on demand. So you can see there, the previous chart only went back to 1990, but this chart shows you the 1980s and where the red meat industry was really hit with information around cholesterol and saturated fats and connections with heart disease, which really reduced demand for red meats as recommendations were coming out of you should be eating margarine, not butter, you should be eating white meat, not red meat. So then you can see the rebound that happened in the late 90s with the Atkins diet and the South Beach diet, and there are a number of other things that have happened in the last 10 years. But the most recent conversation has been around the US dietary guidelines. And there's been a lot of popular literature out there for consumers who are interested in nutrition, including the Big Fat Surprise, which has looked at research and summarized and said, you want to know what? Some of these recommendations from the 80s, they don't hold up with recent research and are actually have been proven to be false. So we can see that recommendations that fat is back as a popular trend, but also the US dietary guidelines have come out saying previous recommendations around cholesterol levels are actually being removed as the science isn't there to support them. And then obviously, we've seen this strong trend for protein in the diet, but there's a gathering storm in question around animal protein. And what are the alternatives in terms of protein sources that consumers can be looking at? And why are they looking at alternatives? Well, part of it is the simple fact of consumers are price sensitive. We can't get away from it. And when we're looking at record high prices, I can't tell you how many calls I get from media outlets that are saying, are prices still going up? I don't want to tell the audience that prices are still going up. And this is a real concern for some. We've got budget-sensitive consumers out there, but we're also seeing some resilience, some really strong resilience, because people really like their bacon. They also really like their steak. And so beef's price relationship with pork has been fairly steady even as prices have increased. And the one change, though, is beef's relationship with poultry. And so historically, beef was 2 times the price of poultry in the grocery store, but now it's 2.5 times. But it's really not creating a whole bunch of switching for the consumer because poultry consumption has been relatively stable since 2001 as consumers just aren't eating anymore. They're at a saturation point. And so those dollars have to go somewhere else. And so when you think of alternative proteins, you can think Greek yogurt or hummus or something else. But one of the main things in terms of beef is the fact that in today's quality-driven consumers, they seem willing to pay more for beef as long as they have an eating experience that justifies the taste. And so this is where the whole obsession with quality grading and consistency comes in, because we really are seeing a consumer both in North America and globally that's willing to pay a higher price for beef. So switching gears a little, we know that prices are going to be pressured, not only from increased supplies of competing proteins, but also from increased supplies of beef over the next 5 years. And it's really a question of how is demand going to hold up on if that is going to determine the magnitude of what those price decreases are going to be. So in terms of Canadian supplies, Canadian beef production was down 9% in 2015. Most of this actually came from reduced exports as packers were able to keep proportionately more cattle here in Canada. But moving into 2016, we're looking at beef production to be relatively stable for a number of reasons. We had significantly reduced feeder exports in the second half of 2015 that's going to offset the reduced calf crop. And so the determining factor on if we're going to be up or down in production is really what are producers doing in terms of heifer retention. And we saw in 2015 a 19% reduction in cow marketings. And this brought the beef cow culling rate below the long-term average of 11%, but it's just barely below. You couldn't call this expansion yet. You'd actually have to go back to 1994, where we were at 9%, or even 2001, when we were at 8.5%, to look at real expansion. So we could see cow marketings need to reduce further to actually support real expansion in Canada. In terms of heifers, we actually have seen reduced heifer slaughter, which is really encouraging. This is one of the first signs that producers are actually keeping heifers back, and this is the lowest since 1995. Overall, we're projecting that inventories on January 1, 2016 are going to be steady to slightly higher. And so as we move into a period of expansion, you got to remember that expansion is the longest phase in the cattle cycle. It can last up to 5 to 7 years. And this is potentially going to be a slow and cautious expansion as we see a lot of volatility in global markets and a lot of uncertainty around what's happening with demand and how much it's going to support increased production both in North America and globally. But there's still a really strong signal for the cow-calf producer to be expanding. We had record large margins in the last 2 years, and ALMA commissioned a medium-term study that came out this spring looking at where the cattle industry was going in the next 10 years. And they were forecasting net margins for cow-calf producers to continue to be strong in 2016 before moderating over the next 4 years and then being back into those historic ranges from 2019 through 2025, but still being in the black. And so this is one where the prices have peaked, but the price signal is still there for expansion, and the global market can take additional grain-fed beef production. But with that said, what can we expect in the next 4 years? Because expansion can be a difficult place to be for a number of reasons. And one of them is the fact that we have inelastic demand. So this is your economics lesson for the day. So if that line on the chart was at a 45-degree angle, we would call that unit elastic. And so for every 1% change in supply, you'd have a 1% change in price in the opposite direction. If it was flatter, it would be elastic demand. So you could have quite large changes in supply with very small or minute changes in price in response. But because we have inelastic demand, which means that line is closer to being vertical, it means that relatively small changes in supply can create quite large changes in price. And the most recent example of this is actually October, beginning of October, where US fed cattle prices dropped $10 per hundredweight. They were lower throughout the fourth quarter, and then the beginning of January, they jumped up $10 per hundredweight in a couple of weeks. The question is why? Fed marketings hadn't changed. Expectations of Fed marketings hadn't really changed. What had changed was carcass weights. So carcass weights ended up being record large during the fourth quarter, larger than anticipated, increased production, and that was enough to result in a significant price change. And so this is going to create volatility and uncertainty that producers are going to have to figure out how to deal with on their operations, because some risk management plans just can't take some of those things into account. The other aspect is price seasonality. And so the last time marketings or prices doubled was in the early 1970s. And the annual average price for cattle was actually fairly steady, changing between 3 and 5% from year to year over the next 5 years. But during that period, the seasonality from the spring high to the fall low ranged between 15 and 22%, as compared to a 21% drop in 2015. Remembering that over the last several years, as we've been in a bull market, we've really seen very little seasonality. So we're going back to a period where seasonality can be quite large and quite volatile. And right there, that's just last week's futures projected back into Canadian dollars for an annual average of around 169. And then you've got the blue line is basically the futures with a historic basis, which is very similar to what they use for CPIP. And then the red dots are based on historical seasonality off of that annual average. So you can see there's some variation depending on where cattle are going to be coming to market. But the other factor that's going to be a big one for the Canadian market and is going to make the Canadian market diverge from the US market is our exchange rate and therefore oil prices. At the end of 2015, the US had a year's worth of production in oil reserves. And on December 18th, the US removed export tariffs for oil, which means they're going to be able to export that product into the global marketplace. In addition, sanctions on Iran were removed. They've already announced that they are going to be increasing production over the next year and therefore increasing exports. We have a global glut of oil right now, and many of the major producers are fighting for market share and trying to make up for lost revenues and lower prices with larger volumes. And you can see in the chart, Canadian heavy crude actually is priced at a discount compared to US crude prices. And US crude prices are forecast to trade anywhere between $25 and $48 a barrel. Right now, they're around 28 to 30, and they're expected to hit that low fairly soon over the first half of the year before rebounding in the second half. And so that's anticipated to be reflected in the Canadian dollar with the exchange rate going down further. So right now, we've got an exchange rate around 69 cents, and we're forecasting Fed prices in Alberta to average around 169, or being down around 8% from last year. But if we saw the exchange rate drop 10 cents to around 59 cents, we'd actually have Fed prices around $200 per hundredweight, and that would be up about 10%. So this is one where the forecast moving forward is actually fairly wide. I'm not giving you a dot in which you can anticipate, partly because there's so much uncertainty in this market. There's so much volatility going on right now, and the question is, what's going to happen with exports and international demand? And I'm just about done, but one final word is country of origin labeling is finally gone. I actually started at Canfax shortly before country of origin labeling went in, and so I was really happy about this. But what's it going to actually mean for the market? We've seen so much volatility right now that it's not necessarily going to be something that you can see, oh, that was cool, and that's what happened with prices in any given week. Partly because the situation and where we are in the cattle cycle is very different than when COOL went into effect in 2008. Right now, we have the lowest dependence on US packers since the early 1990s. And that means that even with COOL gone and US packers being able to come into the market and be more responsive to local supply and demand conditions, that they have larger Fed marketings available to them in the US coming up in 2016. So they're not necessarily going to be as interested in Canadian cattle. But we know over the long term that COOL cost us over $2 per hundredweight on our fed cattle, and that's definitely expected to come back into the market as we see those packers more responsive and coming into the marketplace. So that's it.